to look at trading options in a unique manner using algorithms and automation. No more screen watching. We're going to look at some back testing as well. And we're going to jump into some demonstrations. So with that said, we'll go ahead and get things started here. And feel free to ask questions along the way. And let me take a look here. I see people joining us as well. And yeah, use your chat functionality and feature there to ask questions. And I think I'll probably end up asking questions along the way, or I'm sorry, answering questions along the way. But go ahead and get your questions in there as we move along, and I'll probably have some time at the end for Q&A. So remember, we're speculating, and every time we speculate, we are trying to make a profit, so we accept risk as we do so. And go ahead and take a moment and look at that risk disclosure, or take a screen image or screen capture of it. You can read every word. But the main thing would be that there's always risk of loss when trading. You should be using risk capital, and that past performance is never a guarantee of future results. And a little bit about us. We are AltaVest since 1997. We've been a registered introducing brokerage firm, almost 3 decades now, serving clients, trading millions and millions of contracts along the way. These are some of our staff on the trading floor, the S&P 500 options pit. And of course, it doesn't exist anymore because everything is electronic, and that's part of what we'll talk about today. We're the creator of the Dragonfly option strategy, as well as the proprietary order execution technology to handle that. And we've got these proprietary solutions. We're going to show you a demonstration here in just a few moments. We're registered with the CFTC and a member of the NFA. We're located in California. A little bit about myself. I'm Eric Gebhardt. I've been doing this for quite a while now with AltaVest. I have my BS in Business Administration from the University of Southern California, and I'm a co-founder of AltaVest. I used to be in the securities side of things with my Series 6 and 63 licenses. That's mutual funds and annuities. Currently have my Series 3, that's the commodity futures license, as well as what's called a Series 65 for investment advisors. And a lot of us might think when we're at our desk or on your phone trading, this might be the ideal situation, and that's kind of who you're trading against. Every time you place an order, that is your competition. Well, that is really not the case. This is your competition. Automation, AI, algorithms, HFT, high frequency trading, whatever you want to call it, built-in controls, automation, and no emotion. 70% of the markets are totally algorithmic or software driven, and 65-70% of the American stock market volume, and that number is only increasing. And here's another tidbit here: 50% of global trading controlled by algorithms. So traditional fundamental analysis is no longer enough, and I think that would also apply to what you might call technical analysis as well. So we're going to look at professional option strategies and how we are able to compete in this environment. So we want to trade options like the large institutions do, whether they're large funds or could be a hedge fund, could be a insurance fund. Maybe like an insurance company might trade options. How do they do their business? How do they run their business? Well, we kind of have an idea. They get paid premiums to assume risk, and they sell time, essentially is what they're doing, manage time and risk, and they insure themselves by hedging. And they're consistent and they're patient in the process along the way. And they look at math and probabilities. So what are the odds, and are the odds in their favor? And what I'm going to do here, I'm going to shut the camera down for a second because I think we end up with more room on the screen. Then we can jump back to the camera a little bit later. But so statistics, actuarials, numbers, math, that's what the big institutions use to trade and to run their businesses with. And we're going to try to emulate that, kind of put those odds in our favor. So collecting premium is what we'd like to do when we're trading options. So these are premium collection strategies where we manage risk and reward up front. We use experienced people along the way to help you out, but of course, more importantly, or as important, is the correct automation tools. We're looking for lots of singles and base hits, to use a baseball analogy. So these are short option strategies, and these are directional, non-directional, bullish, bearish, you name it. Options are a tool that can be structured in any way for any particular outlook, and you're targeting outcomes that have a fixed risk. So before you place that trade, you know what the maximum risk will be, and oftentimes what the maximum reward will be. Before we jump in, we have to look at the Greek alphabet in relating to probabilities. The first one here is delta, and that is how much does the option value change with a change in the underlying asset price. So it's also the approximate probability of expiring in the money, and that's how a lot of option traders look at that. So if a delta is at 0.25, you know there's a 25% chance it would expire in the money, but conversely, a 75% chance that it would expire worthless to whomever bought that option from you. Remember, delta is always moving with price and time. It's not a static number, and it is not the probability of a winning trade. So keep that in mind. That's important. And there is theta. So remember, every option has limited life. It's a wasting or a decaying asset. So theta is a negative number, equals 1 day of time decay. If an option's at 10 points and theta is negative 0.05, the next day the premium would drop to 9.95, and after that 9.90, and so forth. And that's how theta looks on a graph here. You can see as you approach time 0 with the option, the value of the option premium drops and drops and drops, especially in the last 30 days or so, 60 days, 30 days or so. You can see the value dropping significantly. So Wall Street professionals use multi-leg option spreads to collect premium. And this woman here in an interview on CNBC talks about option spreads are buying and selling different contracts, a very common way for investors to hedge risk and volatility. It's usually cheaper because you can offset your cost by the proceeds from different contracts. And we'll check in with her again, and I'll show you that link as to where you can find her video and her name. And it's been used by Wall Street professionals for decades. So for example, she's talking about option spreads, and here's one of the most simple spreads you can come up with. It's in this case, a call spread that you would sell, and it's on the E-mini S&P 500 market. You would do this if you're bearish or moderately bullish or even non-directional. And this is what it would look like. This is the spread that you would sell. The red line is the sell, the call that you sell. The blue line is the call that you buy. And the net result of that transaction is you collect 2.25 points, $112.50 in this example, minus your commissions. And then you would look for the market to stay below this upper boundary here, and then you'd be able to cover that position and move on to another trade. Here's an example of selling a put spread that's out of the money. So again, here's where the market is when you place this trade. You sell an out of the money put, you buy an out of the money put for protection or hedge. Still, the net result is, in this case, you collect some money, and over time, market chops around, and you're able to close out that position and buy it back later for less than what you originally received. And you can see the vertical line here is the expiration of that particular spread. And here's an iron condor, and that's just combining the two spreads that we saw, a put spread and call spread, selling both, collecting premium on both sides of the market, selling the call spread, selling the put spread. And the idea is that the market trades back and forth, and then you would then close out that position at some point to buy it back for less than what you originally received. And that's because of theta decay works its magic. In this case here, you can see this blue arrow pointing to this point, and you can see it pointing here to this blue and green symbol. And I'll show you the details of what that means, but that means it's time to get out of the trade. The trade is matured enough, you've made enough profit on that trade, so you've placed a trade and you collected premium, the market moved around, theta decay worked, and then you can buy it back for less money than what you paid for it. And there's the dragonfly. This is our proprietary strategy, and it's a variation on a condor. So you're still collecting premium with puts and calls, and it's a non-directional strategy, and it looks a little complicated on the graph, but I'll show you in the demo how simple it is. But the structure is always the same in increments of selling 4 calls, buying 3 out of the money, and then 1 closer to the money. And the same with the puts on the downside, selling 4 puts, buying 3 further out, and then 1 closer to the money. You'll notice in this case, the 1 put that you buy here is 50 points closer to the money compared to the 4 you sold, so it has a much higher delta. And the same with the call that you own here, 50 points closer to the money. It's not always 50 points. It depends on what the algorithm will generate, but in this case it's 50 points. And what happens is it changes the characteristic of that trade compared to a condor. And here's what happens after theta decay works. So this is the same graph that we saw on the condor in terms of the price, same price movement. And you can see here with 29 days left till expiration, you get an exit signal to close out that position and buy it back. And that's kind of how a dragonfly would work. And I'll show you some of the advantages to the dragonfly. We like the condor as well, but we also like the dragonfly quite a bit, and it really pays off in certain circumstances. So to jump into the demo, we're going to show you a live trade alert as well. You simply touch accept or reject, and then our technology handles the rest for you. Super convenient, just like that. But how would you even know where to begin with these spreads? Which markets are you trading? What strategy to apply? At what price? In other words, what's the timing for your entry? And then, of course, as important, if not more importantly, is how do you close out that position? When do you exit, whether it's for a profit or a loss? And that is something called ThetaTrader. That's your answer with pre-built option strategies with our proprietary algorithm working behind the scenes, creating theta trades on a daily basis. And also the one-touch responsive trade alerts. We'll jump into that demo. And again, any market condition, there are option strategies we can apply. And then people really like the automation as well. Something called the risk thermal indicator, the RTI, that's color coded, and that can be automated so that when you get an exit signal for a profit or for a loss, whichever comes first, ThetaTrader will automatically place that order for you. So we're going to jump into a demo, and I need just a second here to switch screens. Okay, so we're looking good, and we're now looking at my ThetaTrader dashboard here. Let me zoom in just one more bit so you can see a little bit better. But this is ThetaTrader. Here's the dashboard. You'll see at the top active trade alerts, and I'll get into that in a second. These are theta trades up here. And you'll notice there are bullish or bearish or non-directional neutral strategies. They're already filled out for you, kind of like the answers to the test are already filled in for you. And these are your open short positions here. You can see they're all green or yellow, and that means good, do nothing. And they're all in red. That's because they're short positions or sold positions. And then below it would be any open long or bought positions. So this would be your debit spreads up here, and then your credit spreads right here. You can see your account activity. This is all integrated with your AltaVest trading account. So ThetaTrader works with your AltaVest trading account. Then your current price quotes here. So what I'll show you here, since we looked at the Condor and the Dragonfly, let's look at a couple examples. You'll see there are trades available anywhere from 16 to 30 days till expiration. And the strike prices and expirations are already selected for us. This is your maximum profit potential at expiration per trade. This is something called the targeted annualized return, and that just is really here to compare one trade to another. You can't expect if you place this trade here, you'll make 195% a year. That wouldn't be realistic, because that just assumes every 16 days you turn over that trade for a year, and that would be the result. But that's really just to compare one condor to another. And I'll drill down here. This is the March week 3 expiration, and I should also note that this is the E-mini S&P 500 stock index, and those are the markets we're primarily trading. And again, I'll show you why in more detail just a little bit later, but suffice it to say that's where all the liquidity is. But you'll notice this table pulls up here. You can see the trade is already pre-populated for you. But one thing I do is look at the graph. So you can see here's where the market's trading now. Here's the call spread you're selling and the put spread you're selling. And you're looking before expiration here, you're looking for the market to kind of keep bouncing around within this range, and then you'll be able to buy it back for less than what you received. So you can see 30 days till expiration, settlement value, premium, put risk, call risk, commission, cash required. This is actually important. Cash required 916, and your profit potential maximum is $84. And then your targeted return on cash and targeted annualized return. And this is all explained in detail within ThetaTrader. There's a great help file, and I'll show you that too. But here's, people will ask, I have to put up $900 as a deposit, essentially, to be able to maybe make a maximum of $84. That doesn't seem quite right in terms of the asymmetry there. But keep in mind, the puts and calls that are being sold, this put here is a delta of just over 13.5, and I'm sorry, a delta of 9.6, and that means there's over a 90% probability that this put you're selling would expire worthless to whoever you sold it to. And then the same with this call, the delta is 6.75, over a 93% probability that this call you're selling to someone or something else will expire out of the money. So you've got these higher probability outcomes. You have the math favoring you in terms of the probabilities of these options expiring out of the money, and that's why the algorithm has chosen to sell these. You could choose to adjust the strike prices if you wanted, but the algorithm has chosen this for the week 3 expiration, and it defaults to a quantity of 1, and you're selling the spread, you're selling the condor, so you're collecting premium. And if you raise it to 3 or 4 or 5 or whatever, you can see the cash required going up, and then your profit potential going up as well. We'll go ahead, for the heck of it, we'll just choose 7. This is just a demo account I use. We'll leave the value there at 210, and I'll go ahead and place that order. And it just assumes you're filled in this demo account. So that's how simple it is to use ThetaTrader to place what would otherwise be quite a complex order to try to create and manage yourself. And in terms of managing, I'll show you how to manage the actual trade once it's placed. What I'll do here is I'm going to jump back and let's look at a dragonfly. So we looked at a condor, we'll look at a dragonfly. I always just randomly choose the trades with the longer DTE. In this case, this dragonfly has 70 days till expiration. And again, it's pulling up that table with all the details. Here's a graph of what this particular dragonfly looks like. Again, you're selling 4 calls, buying 3 out of the money. and that's an additional hedge or protection, and then one closer to the money for even greater hedge or protection. And the delta on this call that you buy is much higher than the 4 that you sell, and that means theta decay won't impact it as much or as rapidly. It won't lose time as rapidly, and also the delta is higher, so that if the market's moving upwards closer to this this position, this call that you own will increase in value more quickly than the calls that you sold. And the same structure with the puts. So it's a little more risk averse than a condor, and that means your profit potential is generally lower, but there are some big benefits to that. You'll see again the same types of things in the table, but you'll see the cash required 4,600, so almost 5,000 per dragonfly. That's because you're selling in increments of 4. Profit potential, of course, is higher. Your targeted return on cash and your targeted annualized return always defaults to a quantity of 1. You're selling 1. We can jump it up to 2 or 3. Why don't I go to, say, 3? We'll leave the value here the way it is. You can change it if you want. And you can give discretion to the broker if you'd like. That means you're willing to take, maybe as little as 8 points to get the order filled, but for the sake of this demo, we'll leave it the way it is. And again, you see the puts and the calls here, 9.65 and a 6.13 delta. So almost a 94% probability that these calls you're selling to someone else will expire out of the money. And then the delta here, 9.65, so over a 90% probability that these puts would expire out of the money. So we'll go ahead and place that order for the sake of the demo, and it's just that simple. And now here's a really, really great feature, and this is a backtesting engine or a time machine for options trading. You can go backwards in time and look at how these strategies would have done, and you can use something called the trade simulator. It's right here, and for the sake of saving some time, I loaded a couple examples. Let me squeeze this down. So this is a week 3 February condor on the S&P 500. And you can use these buttons here to go forwards or backwards in time, or you can go right to the end at once. And you'll notice as you go day by day, you'll see the activity for that day. Here's the market movement dropping or increasing or whatever it might be doing. And then this is the RTI. That means do nothing. It's green, so that's good. You can see the P&L on the trade typically will start out negative when you place a premium collection strategy, and that's in large part because theta decay hasn't had a time to work. And we'll go ahead and just play this here. Turns yellow, but still do nothing here. So far uneventful, and then you get a profit-taking order. When it turns blue, that means take profits, and with 23 days till expiration, ThetaTrader says get out of that trade, take your money, and move on to the next trade. And we can automate this, and I'll show you how to do that. But that's the February week 3 Iron Condor, pretty uneventful, and here's the expiration date. So you're getting out before expiration, and that's what ThetaTrader will always have you do if you follow the automation. You're always going to be out before expiration. So here's the week 3 Dragonfly. So same expiration, same market, and again, get a profit-taking signal. Very uneventful, very similar to the Condor. So those trades worked out well. Now let's show you some other trades here that don't always work out, and that might be a differentiation, one versus the other, Condor versus Dragonfly. So here is one from May 15. This is a Condor, and it's doing just fine. And this is the week 2 July expiration. It turns yellow, getting a little bit elevated there in terms of risk. P&L's a little negative, but still do nothing. Getting a little more elevated here, the risk. And then it turns red. Too much risk, and that's your signal there to close that trade out. take your loss and move on to the next position. And you can automate it when it turns red for a loss or blue for a profit. And again, that's the July week 2 condor. Now let's compare that to the July week 2 dragonfly. If you had a dragonfly and a condor placed on that same day, and then the market did what it did here, how would the two have compared with each other, the condor versus the dragon? Look at that. You get a profit-taking signal here with 15 days till expiration. So 2 weeks before this expires, the dragonfly has a totally different characteristic compared to the condor. And again, because you own this call right here, and as the market was moving higher and higher, this call that you own was increasing in value more rapidly than the others that you sold. So that delta actually helped you. And this position worked as a great hedge and allowed this trade to actually mature so you could get out of it, move on with a profit, and go to the next position. So that's the big difference sometimes between a condor and a dragonfly. Here's a December condor. Let's look at another one. So you can see right away, here's the market when the condor was placed, and then right away it just shot higher pretty quickly, and also a lot of within a high degree of magnitude, I should say. And then you get a profit-taking signal finally with 3 days till expiration. So the condor worked out. You're out of it before expiration. But let's compare it to the dragonfly, that same trade. That's the December E-mini S&P 500. And here's that same expiration on the dragonfly, that same trade, same day. Scroll down here. So turning yellow, but still do nothing. Look at that. You were able to close out that trade. The order to close it out for a profit was placed with 9 days till expiration. And if you were in the condor, you had to hang in there until, well, almost another week, 6 extra days before the condor gave you a profit-taking signal. So there's a big advantage at times having the dragonfly versus the condor. It will be more robust. It will sometimes avoid a loss that the condor will take, or it'll allow you to close out a trade earlier compared to a condor. So that's why the dragonfly is oftentimes preferred, but you will take less profit potential from each trade. That's the trade-off. All right, so that's a great example of trading the condor versus the dragonfly. And I wanted to show you also the trade alert functionality. Well, before I do that, let me just show you also we have for you available your proprietary research as part of ThetaTrader, and that's something called TradeScope. We do this daily. It's a daily kind of a technical outlook as well as global macro landscape, and then also looking at what's on the radar. So that's also part of ThetaTrader, the research. And then we have something called the daily commentary. And this is looking at Asia, it's looking at Europe, looking at the US, and then anything moving forward, and also the economic calendar. So that's all in one page, just like TradeScope. So it's a real short, concise read. Clients like that, as opposed to trying to find information scattered online. And there's a great help file here, and I'll show you. This will show you how to automate the exit. So you would just go, first of all, let me show you the help file, the glossary. So you'll see all of the terms described here in detail, all the expirations, you'll have all of the definitions, and then you have the color coding described and how that works on the RTI, and all the strategies described, and symbols, and everything is right here on the help file. But the main thing you want to look for, or another thing I should say, is the settings, and you'll see here, this is how you initiate all of your commentary and text messaging alerts and so forth, and you'll save your settings, and then you activate the risk manager right here. So we saw how when it turns red, then you'll get an order triggered to close out that position, and that's the default setting, red. But you could go to an orange, and that's fine, but keep in mind you're going to have more frequent losses, but the losses will be generally smaller. And then you could even customize it anywhere from a 25 to 40 level, or I'm sorry, 25 to 50. And if you do that, that's okay. Maybe you go down to 25, but again, that means you'll just have more frequent losses, but each loss will be smaller compared to the default level. So it's really a trade-off there. And then you would save those settings right here, and then you can activate your profit directive as well. And each time you just save the settings with that little button. So that's how you control your automation for managing the risk and the profits with all of the open positions in your account. So it's really that simple. Now let me show you back to the dashboard. Let me zoom in just a second here. Might as well show you while we're here. You can go to your closed positions here, all on one page if you'd like. Then I want to show you the trade alerts, which I think might be the best feature of all. So you can filter for your positions based on, date or market or entry or exit or whatever strategy. But this is just what you would see on your closed positions page. You see 20 at a time on the page. So you can see 20 trades. There's 17 winners, 3 losers. Total gain here. Short positions or short strategies, collecting premium, I should say. 13 trades, 13 winners, 0 losers. 7 long positions or debit spreads, 4 winners and 3 losers. Now, this is just a demo account, so not to suggest you're going to have, no losing trades if you just sell premium. That's not the case at all. There are windows of time where any strategy has a hole and you'll have losses for sure. This just happens to be the demo account I use, and a lot of these trades are just working very, very well in this environment at the moment. But it does show you that I think generally speaking, the theme of collecting premium does have mathematical odds in your favor. So typically speaking, your account would probably look like this in terms of the ratio, or at least the idea that you'll have more winning short positions compared to winning long positions. So, buying options is really not a winning strategy, but selling options over time mathematically certainly seems to, you have probabilities on your side. And if you wanted to look at any strategy, you might say, or trade, you want to look backwards in time, you click on it and it highlights it there in gray, and you can get an idea here. For example, here's what this trade looked like when you placed it. Market dropped and dropped and dropped, and you actually had a profit taking signal here, right there, the blue. So that's how that one worked. So that's how you look at your closed positions. That's just kind of randomly picking a trade. So let me jump back to the dashboard. I'll point out one or two other things, and then I'll show you the trade alerts. Wanted to point out that we also, as well as the E-mini S&P 500, mini NASDAQ 100, and Russell 2000 mini, we do have gold listed in here, and we think it's important to have some exposure to gold right now, or bullish exposure, I should specify. So you'll see every day there are some gold trades that you can look at. You can see here, in fact, you can see a couple of these positions here are gold, the long gold calls, and they're both doing very well at the moment. So here's how that spread looks right now. Here's the current gold price. Here's the long call that you buy, and the call that you sell above it. So we'll show you just a few little tidbits here in the next few minutes, more on gold. But beyond that, I want to point out you don't have to just be non-directional. We looked at the dragonfly and the condor, but maybe you're looking for some portfolio protection. You want some bearish strategies, or maybe you want to hang on to some bullish positions in your stock trading portfolio and you don't want to sell them. Maybe you can buy some puts, or buy a put spread, or sell out of the money call spread, or whatever it might be. So there's a lot you can do here, whether you're bullish or bearish. And here's something called a bear hedge. This just happens to have 30 days till expiration, but it's a term we came up with for the idea of simply selling an out of the money call spread, collecting that money, and then using it to finance the purchase of an out of the money put spread. So here's what it would look like. Here's the current price. So you sell this out of the money call spread, collect money for that, but then you turn around and use that money to buy an out of the money put spread. You can usually do this for even money, sometimes a credit, so it doesn't cost you anything. So if the market were to start dropping, then if it drops quickly enough, then that trade should work out well for you. But you'd also have to manage it. You'd have to manage this short call spread if it shot up higher, just like you would with any other trade or any other short call position. So that's what it looks like here. I won't go into the details, but it always defaults to the number here that you're trying to either buy or sell it for. You can change the quantity if you like. We'll do, let's say, 5 of those. And there, just that simple. Okay, so let me go back to the dashboard and let me show you the trade alert. So if you have a ThetaTrader membership with us, and you'll have access to the dashboard and everything that you just saw. But I think even better is that you'll be on board with the trade alerts, and you'll see on your dashboard, whenever there's a trade alert, it'll show on your dashboard. And here's an example of selling 10 of these dragonflies, and you click on view and it pulls up this graph. Has a description. This is the April week 1 S&P 500 dragonfly spread. It has 44 days till expiration. This is the call structure. Here's the put structure. That purple line, vertical line, is your expiration date. You see the current price. And I want to point out here that the quantity is already pre-selected for you and your account. So every alert you receive is individualized and tailored to your account based on your current account balance and also what other positions you have open in your account. So you won't receive an alert if you already have, for example, this exact same trade or something too close to it in terms of the strike prices. And also the quantity is sized for you, where you're only risking a very small, percentage of your total account value on any one trade. Now you can adjust the quantity here lower if you'd like, but you can't go higher. So you cannot add risk to an alert, but you can lower the risk, or the exposure, I should say. So this came in here, and this was sized for this demo account at a quantity of 10. Maybe I'm feeling better about 8. For whatever reason, I would accept it by clicking here, or I could reject it. You can see the trade here is all described. You can see the visual of it. You're trying to collect 7 points or higher. Net premium $2,128. Cash required. Has 44 days till expiration. We'll go ahead and accept it. So that's how easy it is to accept a trade alert from your dashboard. All right, now what's even better than that, and give me just a second to switch screens again. Let's look at how the alerts might work. Okay, here we go. So we mentioned the trade alerts there on the dashboard, but you'll also receive those on your smartphone. So one touch responsive by touching accept or reject. And again, these alerts are what we call live or integrated with your AltaVest trading account. And you simply touch accept and our technology handles the rest. So here's what it looks like when you receive an alert on your smartphone. You'll get a text message. It's an active link, of course. And it will take you right to the alert page. You can see the description of the trade, the graph of the trade, just like we saw. You'll be taken to that alert page, very similar to what you saw on the dashboard. You'll notice the quantity is pre-selected, the entry price, how much you're trying to collect, what's your cash required. Of course, the graph here of the position. So all those same details we looked at earlier. We talked about the quantity being editable, I guess you could say is the word. If you want to place it, you just touch accept, and that's how easy it is. Okay. So we're back to where we left off. There was a glitch on that video or something, but you saw how easy it is for the trade alerts to come to your phone. And here's how to get started with your membership. So you get a ThetaTrader membership and includes everything that you just saw. All the software, the Theta trades, the RTI, it's all color coded, the trade simulator, backtesting, valued at over $3,500. And then you have the trade alerts as well. And you'll receive those via your dashboard, also via your smartphone and via email. And those alerts are integrated with your account. So they're interactive, they're dynamic, they're live, I guess they're hot, as they say. Those alerts are $4,464 valued. Touch, accept, or reject. That's all you have to do. We handle everything else for you. So the alerts, the ThetaTrader software valued over $8,000. And then you have us to work with you. So we're all licensed and experienced with decades. Everyone here has at least 2 decades of experience. So you have private coaching. We'll share screens with you, walk you through whatever you need to in terms of your trading history, discuss your strategy moving forward, look at your account, explain whatever it is you need help with. That's really an invaluable service. We have that valued there. You see $7,500. I know people spend $25,000, maybe $50,000 on coaching, on systems, but with ThetaTrader, that's all included. So we'll be your co-pilot or your wingman. So your membership, you get everything, the software, the alerts, the private coaching, everything is included, valued at over $15,500. And then there's always that, but wait, there's more kind of bonus. Don't forget that proprietary research with TradeScope and the daily commentary. People like to really rely on that as well, just to keep you informed, give you some talking points to use at the water cooler type of thing, but very useful, informative. You have online tutorials. There's video tutorials available within ThetaTrader. So if you need a little review on how to track a trade or place a trade, there's like a 1 minute or 2 minute video on how to do that. Very user friendly. So again, this is a lifetime membership. All of the software, the alerts, the private coaching, the research, $18,500 value. But of course, that's not what we charge. We did do this in live in-person events, and it was a $4,000 membership at the time. But we don't do that now because obviously we're online. And our retail price, $997. So if this were not a live event, but we like to do a big discount for these events, $597, one payment. This is your link to get started, cf.altivest.com/TT. And there's my direct phone number and email. If you have any comments or questions along the way, I'd love to hear from you. Take a screenshot of this and this link as well. So you can see the green arrow there kind of flashing. All you have to do, you just fill out that form and then click become a lifetime member. And the offer does expire tomorrow night. So you have some time to email or call if you have a comment or question. But let me show you. Here's something a lot of people like to utilize as well. You become a member and start trading within 30 days. You've got 100,000 or more, you'll get a full rebate. If you have 25,000 or more, you'll get a 50% rebate. So get yourself started. I'd like to see you get active and involved. If it's something you want to do, you might as well go ahead and get started and get that rebate. People like to take us up on that offer. There is a 30-day money-back guarantee, so really you don't have any risk on signing up and becoming a member. And we've got some FAQs now. Let's see if I do have anything, comments or questions yet. See a lot of people in the room here. And if you have any comments or questions, go ahead and throw them in there. But I will probably answer a lot of these as we go. Tax efficiency. Absolutely, we're in a tax efficient space. So everything you're doing with us is treated differently by the IRS compared to most of what's happening in, say, securities. So these are 1256 contracts. It means your gains are taxed at the lower capital gains rate. So an example might be if you're comparing a futures trading account compared to a stock trading account. In this mathematical example, you might have a tax savings versus individual stocks, quite a bit more so, compared to the stocks, and that's because 60% of those gains are taxed at the lower capital gains rate. So do contact your tax expert on that, but also you get a 1099 at the end of the year. You don't have a whole bunch of things to inventory and wash sales and all that and itemize. So it's very simple. You don't have to do what this guy's doing here. So again, consult, not insult, consult your tax attorney or advisor. An IRA, absolutely. People transfer IRAs every week, so you can use that as well. And why the E-minis? Why the E-mini index options? Well, generally speaking, they're liquid, they're operationally and capital efficient in terms of margin, extensive range of expirations and sizes, and then options, flexibility, execution. So I won't go into all the details, but this is really a big one. When you're trading a liquid market like this, the algorithm is going to find the strike prices that it needs. So in the E-mini S&P 500, liquid, efficient, cost-effective, densely packed strike prices, 100 annual expirations ensure granularity and coverage. So you get that superior execution according to the CME group with the ES options compared to SPX, and they offer you a cost savings on the execution. So that's what they're referring to here is the tight bid offer spread. And you get that liquidity and a wide array of maturities that we talked about. So here's an example of a condor trade. Here's some calls and puts. And then as time goes by, the algorithm in ThetaTrader will look for more calls and more puts to trade. And whether it's a dragonfly or condor, it doesn't matter. And then it'll look for another set of calls and another set of puts. So as time goes by, it's looking for the strikes and expirations that it needs. And that's why the liquidity on these E-minis is so important. And here's a big selling feature for the dragonfly. When you're trading with us using ThetaTrader, you can do dragonflies as one trade, meaning one order placed at one trade with one price. You don't leg in. If you're doing this with a individual stock, you're going to have to break up that order into two separate orders and manage it as two separate spreads. So it's really inefficient and it's a bit of a nightmare. So this is really a large benefit to trading the dragonflies with us, and that's why we created our proprietary technology to be able to do that. So you have immediate access to these sophisticated strategies. Now you compare that to option buyers. So traders are out there just buying options. That's not what pros are doing. Only the rookies just only buy options. And it's really the worst strategy you can rely on. So if you only buy stock options or any options, Theta is always working against you. So here's that link to the woman I was telling you about earlier, and here she is again, Yun Lee. She made a great little video here, so I use her comments. She says the appeal for a lot of retail investors to buy options is that they're much cheaper, but your potential for profit is actually not that high. And what she's referring to there is the probability of success is so low. In 2021, 11% of Robinhood active users made an options trade, but of that, fewer than 1% actually made a multi-leg options trade or a spread. So very unsophisticated traders, at least on the Robinhood platform in 2021. So the E-mini S&P 500 and NASDAQ 100 are driving growth in equity options trading, average daily volume exceeding records of 1.6 million contracts. So it's just, there's a lot of liquidity here, folks, and this is what it looks like. Average daily volume just continuing to get bigger and bigger, and that's just good news for us. That means tighter, hopefully tighter execution and more liquidity, getting in and out more quickly, and then of course having access to all the different strikes and expirations we need. More advantages on the E-minis. Why not just track one or two of these markets and as opposed to 6,000 securities? And we mentioned efficient use of capital, and there's a clear cost structure too. That's something they don't mention at the CME group, but I think I'll mention it here. These are not securities options. Everything trades at the CME group on the Globex electronic exchange. So every order, whether it's a order for one spread or 1,000 spreads, every order is flowing through the Globex electronic exchange, and it gets equal treatment. There's no payment for order flow. If you're not familiar with that payment for order flow, if you're trading stocks on like a free platform, that's what's happening to your orders. They tell you it's commission free, but your orders are being sold to a third party to be executed. But it turns out your orders are executed at prices inferior to other brokerage prices. So anyway, you pay for it one way or another. There's no such thing as commission free. And our rates, they're 5.25 round turn. That's all inclusive, and that includes all fees and both sides of the trade. Here's an example just from last month. Here's a big brokerage firm. They say they're $225 a contract, but that's per side. That's just getting, half of the trade. And then there's other fees on top of it. It ends up being higher than what we charge. So our rates are often very competitive. And ThetaTrader's performance is a question people will ask. The performance is different for everyone. Everyone is self-directed. So everyone has their own performance. And I should have pointed this out in the demo. All calculations are net of trading cost. So everything is already within the numbers. All the different account types. And then again, why even focus on something like ThetaTrader? Well, alternatives may improve diversification and lower portfolio risk. But risk of what? How about inflation? Look at this, the dollar down 99% since 1971, since going off the gold standard. Here's a $1 million house when we were kids, and here's that house now. So that's the inflation shark eating away at our wages. Here's investor Ron Barron suggests long-term inflation is 4 to 5% every year. I think that's probably quite accurate. Gold has been moving up, obviously, as the dollar has been dropping. And we mentioned gold in ThetaTrader as well. That's why we think it's important to keep gold on the radar screen. This guy here is happy that gold's at all-time highs, but well, it's just because your currency is declining. So you got to kind of play defense sometimes. Look at this. Even Apple revenue is down, inflation adjusted. So you would think, oh, Apple stock is doing so great. It's so hot. It only moves up. But inflation adjusted for the last 4 years or so, it's actually negative since 2021. So gold, ETF demand is strong. U.S. budget deficits continue, driving currency inflation, which, inflating the currency drives consumer prices higher, or price inflation. Foreign central bank demand is high, and then you have the BRICS interested in gold as well. So anyway, just a little side note on gold, but ThetaTrader is that alternative solution and allocation to something like ThetaTrader with all the strategies and flexibility for any market condition. You have a wide margin of error on those dragonflies, for example. It's convenient that automation saves you time. You can diversify with those non-correlated approaches. What that means is it's just not always bullish. Non-correlated means whatever the S&P 500 is doing, your ThetaTrader positions can be doing something different. And then you have those one-touch responsive trade alerts. And then you've got the bull, bear, technical strategies, non-directional strategies. So these are not day trading strategies. We're not picking stocks. We're not trying to always be bullish or always be bearish. We're not doing this kind of analysis. According to my calculations, the stock market will fluctuate. So yeah, we're not doing that. We like the margin of error, as we say it, on the dragonflies and the condors. Sometimes it's wider than other times, depending on essentially market volatility. It's a time saver using ThetaTrader. Who has time to spend consuming 10 to 12 hours a day in front of their screen? Again, diversification, sort of that non-correlated approach to trading. They call absolute return as well. So your portfolio probably shouldn't look like one or two. We think number 3 makes a lot of sense. Have a slice into the alternative pie, and we're part of that alternative pie. Keep in mind S&P valuations at historical peaks. This is interesting. Based on metrics like PE, market cap to GDP, we're at historical extremes right now, right here. So something to keep in mind. How about the price to sales ratio on the S&P 500? The blue line here is your median price to sales ratio, and here we are now, almost back to the .com record levels. And the S&P 500, for example, if you're in the or Nasdaq or whatever, it's really not diversified. Here's the top 5 stocks, made up almost 29% of the value of the S&P 500. The top 10% is now 75% of the total market. And in the .com bubble peak, it was 73%. That's pretty crazy. But the top 10 stocks now are almost 40% of the index. So you've got this record concentration in the stock market now. It doesn't mean it can't keep going. There's a lot of momentum, but it's certainly something to keep on your radar screen. Even large drawdowns in the markets. When you look back in time, 150 years, it doesn't look like much, but each one of these red areas here lasted 10 years or 20 years. So if you happen to buy at the wrong time, you're going to perhaps be take a decade or two to get back to where you started. Even the .com bubble, people forget, Nasdaq dropped 80% from its high in I think it was March 2000, and it took 15 years to recover. So if you were unfortunate enough to buy at the worst time, it took you about 15 years to recover. So keep in mind, ThetaTrader, it's nimble, it's flexible, can be used for any approach. You can speculate, maybe even hedge your stock portfolio. These are unique strategies available to you at your fingertips. Use automation. You just touch that accept. You can respond to those alerts again on your dashboard with your email or on your smartphone. So there's on your dashboard. Touch accept. You get an email as well. You click the link. Of course, you see on your phone. You can click that link and get the alert, and then just touch accept or change the quantity and lower that if you want. So there you have it, folks. You get ThetaTrader with all the options, trading software, and the alerts along with your personal coaching. And you'll simply go to the link, and once you sign up and become a member, this is what will happen. You'll get your ThetaTrader login. You'll get an email with a link to open your account. And once your account is funded, you'll be able to start trading. Just that simple. So again, this is some screenshots here of the algo-driven options trades. Helps to control your emotions. Strategies, bullish, bearish, or non-directional, very flexible. You have that trade simulator available to you. Don't forget about that. You can go backwards in time and look at how these strategies may have done So there you have it, folks. That's our discounted membership available through tomorrow night. There's the link. There's my direct phone number. And people sometimes ask, oh, I see, people will ask, okay, what's the minimum amount to start trading with? Well, you saw a Dragonfly has a margin of about 5,000. So, kind of keep that in mind. If you want multiple Dragonflies in your account, populating the account simultaneously, you should have maybe 50,000 minimum, and you get a rebate as well. But let me know if you have a number in mind, and I'll tell you if we can work with it or not. Unfortunately, we can't work with people in Canada. You have to have a valid legal U.S. residence. Same thing with the EU, and that's just out of our control. We'd love to have you, but we have a lot of clients in places like Australia, people I think in the UK, and even parts of Asia. But believe it or not, our biggest trading partner, Canada, we can't have an account with. So yeah, someone's asking about another presentation. Well, there is a replay coming out, so this is being recorded. So you'll be able to see the replay here shortly, but that's a good comment. And let's see if there's any other comments or questions. We've got you here for just about an hour, so I think we probably, let's see if there's any questions here. I think we're good. All right, thanks for the questions and comments and joining us, and we hope to have you on board, and I'm available for any additional chat afterwards, and I look forward to hearing from you. Let's see, will it work? Here's a question on, well, this is all web-based, so it's all internet-based, and you don't need to have an app to download. So yeah, it works on any browser. But thank you for the question, Richard, and I see Thetis as well with another question that I responded to. Yeah, we'd love to have you on board. I think you'd like using it. Once people start to, use it, they just think, wow, I'm so glad I don't have to babysit my trades anymore. So that's really one of the big advantages. But all right, folks, we'll wrap it up. And thanks for your time and joining us. And I look forward to hearing from all of you. All right, bye-bye.